The annual Jackson Hole Economic Policy Symposium opened on Thursday in Jackson Hole, Wyoming, bringing together central bankers, economists, financial market participants, and policymakers to discuss key economic and financial issues. The event has served as the backdrop for a number of speeches that have shaped monetary policy and financial markets. For more on this, we're joined today by Greg Buchak, professor of finance at Stanford Graduate School of Business at Stanford University. So, Professor Buchak, thanks for coming on. A lot of attention is now focused on what Kevin Warsh will say at the Jackson Hole Symposium. What should we be watching for in terms of the direction of monetary policy and the Fed's approach to inflation?
Sure. So I think the key thing that I'd be listening for is his framework, rather than him saying, oh, we're going to hike in the next meeting or something like this. So what do I mean by this? First, I think, what does he think is causing inflation? Is it mainly due to excess demand that the Fed needs to restrain? Is it supply shocks that the Fed should wait out? Second, what's the evidence that would really make him act? So inflation has hovered around 3% for a while. If inflation stays around 3% while employment remains strong, is that enough to justify a tighter policy, or does he want clearer evidence that inflation is becoming embedded in wages and expectations that would suggest it's something sort of longer term and something he needs to act on? And then third, sort of how much tightening does he think the Fed needs to do in a context where financial markets are already sort of raising rates on the longer end? So longer term rates are much higher. And the question is whether these longer term rates are already cooling housing markets and business investment. And if that's going on, Warsh may see less need to raise short-term rates immediately. So again, I wouldn't focus too much on whether he says, oh, we're going to hike in September. I think that the bigger question is, what's his policy function? What's worrying him, what's he's watching, and what would cause him to tighten or loosen policy?
Right, and the Fed is still sharply divided over a possible rate hike, right?
That's right, yes.
Right. So how might the inflation, the current situation with the current economic situation determine the Fed's next steps?
Sure. So I think, one way to think about what's going on in the U.S. economy right now is there's a lot of sources of demand kind of competing for the same real resources, and that just makes price goes up. So, you have this huge AI build out. It's demanding electricity, construction, chips, skilled workers. You have big government expenditures and deficits. That's adding demand as well without kind of an offsetting government revenue that's sucking up demand. And then at the same time, you have an aging population and some regulatory blockers to real investment. And this means the labor supply and productive capacity are growing sort of more slowly than they would otherwise. So things like AI, they may be enormously productive, but sort of right now we're in the investment stage of that. We're building data centers, we're buying chips, but we haven't seen sort of the comparable explosion in the physical supply of housing or energy or manufactured goods that would push prices down. So I think sort of the basic tension that's going on, there's very strong aggregate demand, and that's hitting relatively constrained aggregate supply. That's kind of the natural environment for inflation to remain sticky, even as things like consumer spending begin to cool.
Right, and last month's personal consumption expenditure came in slightly higher than expected. What does that tell us about the current state of the U.S. economy?
So that's saying that the Fed is targeting a 2% inflation rate over the long term. 3% is above that, and we've been above that for a pretty long time. So that's really saying this level is higher than what the Fed wants. Labor market is still resilient, consumer spending is still resilient, but this is all sort of happening in the context of big investment and big government deficits that are sort of pushing up aggregate supply.
I see. And tech stocks lifted Wall Street after NVIDIA said it forecast a 70% jump in revenue in the next fiscal year. Now, the market for AI computing is expanding rather than peaking. Will this help reassure investors who have questioned how long this AI spending boom can last?
Yeah, I think so. And this is also a big part of the inflation story as well. NVIDIA is basically saying our customers still want vastly more computing power. Now, as for whether there's a bubble, I think there's kind of an important distinction to think about here. So NVIDIA's results tell us that people really want to use the technology. It doesn't necessarily imply that the technology is being put to a very productive use or that it will ultimately make money for different parties in the economy. So for the first point, frankly, if you've used it, the technology is really, really good. It keeps getting better. And I think we will see real productivity gains from it once we see sort of a build out of this and a way for this to percolate into the real kind of physical economy. Now, for the second point, it's not clear who ultimately in the economy is going to capture these gains. There's the hardware providers like NVIDIA or SK Hynix, the AI labs like OpenAI or Anthropic. They may capture a large share of the rents. On the other hand, there's increasing competition on both fronts from China, from open source models, and things like this could translate into the benefits being widely distributed, captured by businesses, consumers who are ultimately using the tools. So I think, if the question is AI demand real? I think the evidence is increasingly yes. But the question of, are we in a bubble? What's going to happen to asset prices? That's really about who captures the economic rents. And there could be big AI losers even if the technology itself is very successful and widely adopted.
I see. All right, Professor Buchak, thank you so much for coming on today. We appreciate it.
Thanks for having me.